Have you ever checked Twitter at the end of a winning week and somehow ended up feeling worse? You're up 5%, a good week by any rational measure. But then you see a thread from someone who's up 40% on the year, and another trader posting a single trade that made more than your entire month. And by the time you close the app, 5% doesn't feel like a win anymore. It feels like falling behind. Welcome back. This is episode 8 of our trading psychology series. Today, we're going to talk about an emotional pattern that doesn't live inside a trade. It lives outside. It comes from comparing your trading to other people's trading, and it quietly destroys more strategies than any single losing trade ever could. It's called the comparison trap. Quick explanation for anyone hearing this term for the first time. The comparison trap is the habit of measuring your own trading against someone else's visible results, not against your own goals, not against a market benchmark, against the trader you just saw on Twitter, or in your Discord channel, or on a YouTube leaderboard. The problem isn't comparison itself. Comparison is normal. Humans do it constantly. The problem is what you're comparing against, because what you see of another trader is never the full picture. You see their wins. You don't see their drawdowns. You see their final numbers. You don't see the size of their account that made those numbers normal. You see the trade they screenshot. You don't see the 4 losing trades that came before it. You're comparing your full experience to their highlight reel, and the highlight reel always wins. Let's start with the math. The math of comparison is brutal. If a trader posts a 40% year, your brain hears they made 40%. But you don't know, was that on $1,000 account or $1 million account? 40% on $1,000 is $400. Achievable, but not life-changing. 40% on $1 million is $400,000. Life-changing. Same percentage. Completely different reality. Your brain doesn't process this distinction. It just compares percentages. The trader who made $400 on a small account is presented the same way as the trader who made $400,000 on a large account. You compare yourself to the percentage. But the percentage isn't the story. The capital base is. And the capital base is almost never disclosed. So you're comparing yourself to a number that has no context. And you're losing the comparison every time. Now let's talk about the neuroscience. There's a specific reason this happens, and it's wired deep. Humans evolved in small groups, maybe 150 people maximum. In those groups, your status mattered. Your relative position mattered. Comparison wasn't a flaw. It was a survival mechanism. The trader you compare yourself to on Twitter isn't part of your group. But your brain doesn't know that. To your brain, anyone whose posts you see frequently is part of your tribe. And if your tribe is full of 40% a year traders, your brain interprets 5% as low status. Even if 5% is a perfectly good return. Even if those 40% a year traders are mostly survivorship bias. Even if half of them will blow up by next year. In the moment, your brain says, I am the slowest gazelle in this herd. That feeling is unbearable. So you start to trade differently, bigger, faster, riskier, to catch up with the herd. The herd is imaginary. But the trades you take to catch up are real. There's a second mechanism that makes comparison worse. Algorithmic amplification. Social media doesn't show you a random sample of traders. It shows you the ones who get engagement. The trader who's up 40% gets clicks. The trader who's flat for the year doesn't. So your feed becomes a distortion of reality. You think most traders are winning big. In reality, most traders are losing money. The vast majority. The ones you see on your feed are the rare exceptions. And the exceptions of the exceptions. If you saw a representative sample of all traders, your perception of what normal returns look like would crash overnight. But you don't see the representative sample. You see the filtered top. And then you measure yourself against that top as if it were the middle. There's an identity component to this that's hard to see in yourself. The trader who falls into comparison starts to define themselves by recent rank. I'm slower than the timeline this month. My win rate is below the channel average. I keep missing the trades that everyone else catches. These statements feel like analysis. They're not. They're identity formation in real time. When you say, I'm slower than the timeline, you're telling yourself who you are. And the trader who believes they're slower than everyone else behaves slower, hesitates more, takes worse setups when they finally do click. The comparison becomes self-fulfilling. The way out is not to win the comparison, it's to stop entering the comparison. But that requires noticing when the comparison is happening, which is hard, because it doesn't feel like comparison. It feels like just checking Twitter. Let me describe 3 specific situations where the comparison trap destroys trading. The first situation, the leaderboard chase. Some platforms publish trader rankings. You can see who's up the most this month. If you watch those leaderboards, you'll quietly start trying to climb them. That's the trap. Because the top of the leaderboard is almost always a trader who's taking outsized risk. To beat them, you'd have to take more outsized risk. When that risk doesn't pay off, you blow up. When it pays off, you celebrate. Until the next month, when the cycle repeats with more risk. The leaderboard is not a goal. It's a slot machine that rewards extreme positions. The trader chasing the leaderboard rarely survives a full year. The second situation, strategy hopping. You're using a swing trading strategy. Steady 5% a month. You see someone on Twitter making 20% a week with scalping. Your steady strategy suddenly feels boring, so you abandon it. You start scalping. You don't have the screen time, the experience, or the temperament for scalping. You give back your year of steady gains in 3 weeks. Now you go back to swing trading, but you've lost the consistency that made it work. This is one of the most common ways traders break their own edge. Not because the edge stopped working, because they stopped trusting it after comparing it to someone else's edge. The third situation, copy trading. You give up on your own analysis. You start copying a verified trader from a leaderboard, but you don't have their context. You don't have their account size. You don't know what they're risking on each trade. You copy entries, but your sizing is different. Your exits are delayed. Your stops are placed differently. You get the worst of both worlds. None of the upside of their strategy, or the discomfort of trading someone else's setups. Copy trading sounds like a shortcut. It's almost always a slower path to losing money. There's a cultural amplifier in this niche that's worth naming. The trader Twitter, performance economy. Most influential trader accounts make their money not from trading, but from selling courses, signals, or premium groups. To sell those products, They need to appear to be winning. So they post their winners, not their losers. They post percentage gains without account sizes. They post screenshots without showing the losses in between. They cultivate a public persona of constant success. You, watching, feel like everyone is making money except you. But the people you're watching are mostly making money from your subscription, not their trading. The reveal of this, once you've seen it, changes everything. When you understand the incentive structure of trader Twitter, the comparison trap loses most of its grip. You stop comparing yourself to a fellow trader. You start recognizing you're comparing yourself to a marketing campaign. Marketing campaigns always look like they're winning. That's the whole point. There's a specific combination that makes comparison catastrophic. Comparison plus leverage. In spot trading, comparison-driven trading costs you slow attrition. You drift toward worse strategies. You make less money over time. In perps, comparison-driven trading kills accounts fast. Because the way you catch up to a leverage-using trader is to use more leverage. The way you catch up to a 20x trader is to size at 30x. You don't have their experience, their stop discipline, or their emotional regulation. But you take their leverage anyway, because the comparison says you must. And the trade goes against you, and your account is gone in one afternoon. The trader who was leading the comparison walks away from their bad trade with a 5% loss. You walk away with liquidation, same loss, different consequences. Because you were sized for catching up, not for trading. This is why every leverage trading platform has a graveyard of accounts that died chasing someone else's P&L. There's a recurring after effect. The post-comparison shame spiral. You compared yourself. You changed your strategy. You blew up the change. You went back to the old strategy. Now you feel stupid. You blame yourself, not the comparison. You think, I knew better. Why did I do that? This is the wrong question. The right question is, what made me check Twitter at that moment? Because comparison-driven decisions almost always start with a specific trigger. A bad trading day, a bored evening, a run of small losses. In those moments, you check what other traders are doing, and the comparison hits hard. If you can identify the trigger, you can avoid the comparison. If you only blame yourself for the result, you'll do it again because the trigger is still firing. So how do you train yourself out of comparison-driven trading? I'll give you 3 practical rules. 1. Define your personal benchmark in advance. Before the year starts, decide what success looks like for YO. Maybe it's beating inflation. Maybe it's outperforming an index. Maybe it's a fixed dollar number. Write it down. When you feel the urge to compare to someone else's results, go back to your written benchmark. If you're hitting your number, the comparison is irrelevant. If you're not, the comparison is still irrelevant because copying someone else won't fix it. The benchmark is yours. It anchors you. 2. Mute the trader feeds during trading hours. Most people think they need to be informed about what's happening. You don't. Not in real time. Not from individual traders. The cost of constant exposure is significantly higher than the value of any single tip. Mute the loudest accounts. Mute the screenshot accounts. Mute anyone whose posts make you feel worse about your own trading. This sounds extreme. It's the cheapest way to add years to your trading career. 3. Hide your own PL from yourself. If you have a dashboard that shows your account balance in real time, close it. Look at it once a day or once a week. The trader who watches P&L every minute makes worse decisions than the trader who looks once at end of day. The same principle applies to comparison. The less you see the gap, the less the gap drives your behavior. This is hard because trading feels like a numbers game. It is. But the numbers don't need to be felt every minute. They just need to be respected at decision time. There's a flip side worth knowing. Professional traders benchmark almost exclusively against themselves. Not against the loudest trader on Twitter. Not against last month's leaderboard champion. Against their own previous month. Their own previous quarter. Their own previous year. Am I making better decisions than I was 6 months ago? Am I losing trades smaller than they used to be? Am I sticking to my plan more consistently? These are the only comparisons that matter, because they map directly to your edge improving. The trader who beats themselves over time compounds. Year by year, their results get better. The trader who chases external comparisons never compounds. They oscillate. That mindset shift from external to internal benchmarking is what separates trader careers that last from trader careers that end. So to summarize today's episode, the comparison trap is when you measure your trading against the visible results of other traders. It's driven by evolutionary social comparison, amplified by algorithmic feeds that show you a filtered top, and reinforced by an identity that wants to be ranked. It shows up as leaderboard chasing, strategy hopping, and copy trading, all variations of abandoning your own edge to chase someone else's. It's culturally fueled by a performance economy, where trader influencers earn from appearing successful, not from actual trading. Leverage makes the damage catastrophic. Comparison sizing at high leverage is liquidation territory. The 3 practical rules: define your benchmark in advance, mute trader feeds during trading hours, hide your own P&L from yourself. Underneath all of it is the realization that the only comparison that matters is against your own past self. Beat yesterday's you. Ignore everyone else's screenshots. Compound for years. In the next episode, we're going to talk about a pattern that traps people deeper than any other psychology we've covered. Trading addiction. The moment trading stops being about money and becomes about the dopamine itself. We'll break down why some traders can't stop checking the chart even when they're winning. Why the trade matters less than the act of trading. And what addiction looks like in a context where it's culturally celebrated. Appreciate you all for listening. If you enjoyed this episode, make sure to subscribe and share it with someone who keeps comparing their account to Twitter screenshots. And I'll see you guys in Start trading now on Mosey Finance. Trade perps everywhere with one dashboard. Link in bio.